Alright guys, so the banks are in trouble again. In just 2 weeks, something big is going to hit the financial world. The Federal Reserve is going to rug pull a vital lifeline that prevented the collapse of Wall Street a year ago. Then we have to add in the growing crisis of commercial real estate. The loans are turning toxic, the banks are losing a ton of money, and a bunch of them are at really big risk. The longer interest rates stay high, this could cause a deadly domino effect of bank collapsing. And not even rate cuts by Jerome Powell could save the day. And let's talk about leverage. Let's talk about loans first, because this is the big disaster coming for the banks. US commercial property loans coming due have jumped to $930 billion. A big debt bomb is about to explode, and the banks hold over $440 billion of this risk. The volume of loans has risen by 40%, not because business is booming, but because customers are struggling to survive. And this came from loan extensions and other delays, not new transactions. There's a big difference here. It's like you taking a loan today to pay back the previous loan you took 12 months back. It's like the US government borrowing money to pay back the interest on the older bonds. In other words, commercial real estate is becoming unstable, it's becoming unsustainable. And it's really frightening to see Wall Street ignoring the problem like everything's fine. And this attitude reminds us of 2007, just before the historic collapse in mortgages. And I want us to zoom out and understand the magnitude of this problem. Almost $3 trillion of US CRE debt will be maturing through 2028. The majority of this risk lies in the banking sector once again. This year alone, we have a 280 billion time bomb that needs urgent refinancing. Landlords are in trouble, they are deep underwater, and they are taking a double whammy. Rental incomes are dropping because many people they are all working from home like me, and with interest rates staying higher for longer, the interest payments are compounding. Any refinancing done will be at higher rates, piling on even more stress for the CRE owners. And this next chart tells you the shocking reality. In key American cities, office building prices have collapsed. San Francisco led the crash with a 40% drop in prices, while Manhattan saw a 15% decrease in Q4 as well. So if you own an office building that cost $100 million before, now it's only worth 60 million. Does it really make sense for you to keep paying the bank? No, you'll likely default on your loan. You'll take the keys, you'll throw it back to the bankers, and then you'll ride off to the sunset. So the outlook for CRE prices is only going to get worse. Over 70% believe commercial real estate will keep falling well into Q3 this year and even all the way to 2025. And this poses a big problem for the banks. Do they keep extending loans to save their investment, or do they take the hit today and embrace the collapse? And either way, they might not really have a choice. The banks are going to face a horrific liquidity squeeze on March 11, mark that date down, and this is going to impair their ability to issue loans. Lending money will get even more painful. On March the 11th, the Federal Reserve is going to end the Bank Term Funding Program, the BTFP, and because of this one move, all banks across the US will see higher rates to borrow money to stay solvent. And when money becomes more expensive for the banks, it becomes more expensive for everyone else as well, including you and me. And let's quickly recall what the BTFP was all about. It was a program that allowed banks to pawn off all their toxic treasury bonds that were underwater, and they would give this to the Federal Reserve and get 100 cents on the dollar. There was no haircut at all. It's like valuing your house that's on fire, that has burned down, as a brand new property and taking a loan on that. It's a ridiculous, it's a disgusting idea. It was in fact a bailout given to Wall Street by the Federal Reserve. But this program is going to end on March 11, 2024, in just 2 weeks. And this means liquidity or free cash in the banks is going to plummet. And here's how significant this truly is. Over $150 billion of funding is going to exit US banks. 12 months of dirt cheap money is going to end. In fact, the banks were playing with the BTFP to earn a spread on their reserves to get free money, free profit. So this window is going to end. It's a double whammy once again. No more freebies for banks on Wall Street. They can no longer sell their collapsed treasuries at full value again. This closure of the BTFP is going to dry up liquidity and tighten all the lending standards for everyone, especially commercial real estate. So it's not a mistake that Fortress CEO is predicting more bank failures coming. A $1 trillion time bomb is at risk. He believes that the banks were horribly exposed, and with liquidity drying up, this could trigger a domino effect across the entire financial system. Fortress is already starting to buy up CRE loans from financial institutions, and they're doing it by paying only 50 cents on the dollar. And that's a big discount because lenders can't afford to take this hit if things go south. They know that CRE is going to collapse even further, and either they jump ship now or they're going to go down with a sinking vessel. So we can see how everything is interconnected. Because liquidity is drying up from the Fed, the banks can't afford to lend to borrowers to save the CRE markets. Lending at higher interest rates will just make the problems even worse. But a big shout out to our sponsor today, Surfshark. We know the importance of private wealth. Keeping money outside of the system is essential, but securing your data is just as critical. If you're trading or investing in the markets, the last thing you want is for anyone to see or access your data. Without Surfshark, surfing the internet is like dancing on ice. Sooner or later, your luck is going to run out. Surfshark is the leading VPN service that helps secure your privacy and data. Whether it's Wi-Fi at a cafe or making a trade at home, Surfshark VPN encrypts your online data and hides your IP address. And we've all heard of horror stories of credit card info getting stolen, right? Well, worry no more. Subscribe to the Surfshark One plan and Surfshark Alert will monitor your personal data, including credit card details and passwords to alert you of real-time breaches. And this allows you to immediately get in touch with your bank and dispute any unauthorized charges. It helps you prevent further financial damage by allowing you to take action fast. And you can use Surfshark on your smartphone, desktop, and tablet. There's no limit with just one subscription. With over 3,200 services in 100 countries, you can be sure of maximum coverage wherever you are. Best of all, there's a 30-day guarantee that allows you to try Surfshark risk-free. So click on the link below and use my code SeanFu to get an exclusive deal plus 3 months of extra access completely free. Get started with Surfshark today and surf the interwebs with confidence. Borrowers are also sweating bullets. They can choose to default now to stem the bleeding or drown under a huge pile of debt if prices keeps dropping. And it's this dangerous feedback loop that's pushing everything towards a systemic collapse. And we must look at the magnitude of this crisis and why the signs are really bad, why this CRE collapse is progressively getting worse and worse. Do you remember mortgage-backed securities or MBS, the bundling of mortgage loans into Wall Street products, the ones that triggered the '08 collapse? Well, this same problem is starting to build with commercial MBS today. Nearly 80% of commercial MBS products are interest-only loans. This is insane. Interest only means borrowers just need to pay back the interest without paying down the capital. This makes it ultra easy for them to run away when their commercial real estate prices starts to fall. They have no skin in the game, so defaulting is much easier for them. If CRE prices falls enough, borrowers will default, and this will hit the commercial MBS products and all those holding it, especially the big banks. And this feels like 2008 all over again. In total, $4.7 trillion worth of debt is backed by all this US commercial real estate. This is how much money that's at risk in the entire financial system. To a borrower, the loan is a liability, but to an issuer like a bank, this is considered an asset. And if building values continue to fall, borrowers they can just give the middle finger to the banks. If they throw the keys back, the bank's assets suddenly burn up and they become a loss. And they'll be selling all these buildings into a market that's falling. The supply will increase when no one wants them and when everyone is working at home or in cafes. And let's pay attention to two statistics that shows us a disturbing trend of a further price collapse. Everything is tied to price now. The lower it goes, the higher the odds of borrowers just defaulting. The number of foreclosures is spiking up for CREs. In just 12 months, foreclosures have jumped from 300 to over 600. That is a doubling of borrowers throwing away the keys and running away. And this chart shows the amount of CRE that's flooding the market for sale. As interest rates stay higher for longer, this trend will continue to hit higher and higher. The losses in the banks are starting to pile up. And under the surface, we have more loans that are in distress. These are loans where payments are missing. Borrowers have either disappeared or they are dragging their feet. In just 6 months, the share of delinquent loans have flown up. It has gone from 1.7% to 8.6%. That's a five-fold increase in borrowers late on their payments for at least 30 days. A ton of borrowers they are in distress. Their income is going down while interest payments are simply going up. They are scrambling around to find the money to repay their debt. So the loans held by the banks are starting to go bad. The higher this number goes, the bigger the loss will get for them. And it's all tied to interest rates which aren't looking good going forward. And this is where we need to go big picture for a bit. There's a very good chance that this disaster is unavoidable. The Federal Reserve is not going to cut rates until May or even June. And even if they cut, it might already be too late. Borrowing costs can't possibly come down fast enough when you throw in all the headwinds. Inflation in January is still heading up, and it doesn't matter what metric you're using, whether it's core CPI, headline inflation, or the ridiculous super core inflation index. Everything is flying up in prices. And this reduces the odds of a Federal Reserve pivot, a Fed pivot. You add this to the blow up payroll numbers and the low unemployment figures. This looks like an economy that's looking red hot. There's simply no justification for power to cut rates. I mean, the figures are insane. You have 350,000 new jobs, destroying the estimates by huge margin. Not forgetting unemployment is still at 3.7% and wage gain has spiked by 4.5% as well. We know the economy is fracturing, but if we have maximum employment, the only enemy left to fight is inflation. And that's just on the short end of the curve. The Federal Reserve has less influence on long-term borrowing costs, but the situation there points to rates staying higher as well, which is going to push CRE loans off a cliff. The biggest problem is coming from Janet Yellen. Congress is borrowing too much money and forcing Yellen to issue more bonds, and we are reaching a point where the market is starting to puke. We are seeing a slew of US Treasury auctions crash and burn. The 20-year bond auction saw poor results, causing yields to go up. The same happened with the 10-year and the 30-year auctions as well. Yields have spiked to the highest level in the critical 10-year bond since November last year, and this is forcing every single borrowing cost in the US to stay high, including commercial real estate. And this is what happens when you try to dodge reality. The US government is trying to sidestep a recession by borrowing and spending more money, but in the process, they are pushing commercial real estate off a cliff, and it's getting really dangerous. We are seeing a convergence of all the bad decisions come to a head. The excessive borrowing, the weaponization of the dollar, all these are starting to overwhelm the demand for US bonds. So it's no surprise that borrowing costs are heading back up. The 10-year crashed from 5% down to 4% in December last year, and this was good news especially for CRE. But look at the trajectory today. Yields are slowly rising because government spending is out of control. And this is horrible news for CRE. It's by far the biggest risk to the entire global economy today. And it's not just the US that's in trouble. Europe is also heavily exposed to this risk. And check this out, countries like Germany have experienced a 13% crash in office building prices. They are affected as well. People just aren't returning to the office anymore. The banks in Europe are also heavily exposed to all these CRE loans. French and German banks have lent nearly 300 billion euros each in commercial real estate. And this is the problem with higher interest rates. It exposes the leverage in the system. It exposes how fragile the financial system really is. Everything is interconnected. For example, German bank PBB has over 15% of their real estate loans concentrated in the US. That is insane. If US commercial real estate collapses, the bank will take a brutal financial hit as well. Their exposure to America is at 4.8 billion euros, which is higher than their own equity of 3.3 billion euros, and that might be enough to cause a bank failure in the worst case scenario. So understand the risk building in the system. Everything is tied back to interest rates. If bond yields continue to rise, especially on the long end, it's game over, and it's more likely than ever that more banks in the US and even Europe will start to fail, and it's time that we all brace for impact. So how bad is this gonna be? Is the CRE crisis unavoidable? And will we witness a collapse before the year is out? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.